Welcome to Debt Matters. Today, we are looking at a specific development that, on the surface, might look like just another piece of, political maneuvering. It involves a letter sent to the Chancellor, Rachel Reeves, regarding the financial inclusion bill. But if you look closer, this proposal could alter the mechanics of consumer debt in the UK in a very practical way. We are talking about a new push to expand the role of credit unions.
That's right. It's a story that came up recently involving a specific group of Labor MPs making a concerted effort to amend the financial inclusion bill. The headline is that they want to improve access to affordable credit for low-income households.
And usually when we see headlines like MPs write letter to Chancellor, it's easy to just scroll past, isn't it? It feels abstract. But the reason we're discussing it today is because of the specific operational implications this has for anyone involved in collections or consumer credit. It's not just about policy, it's about who gets paid, when they get paid, and how the order of debt repayment might shift.
Exactly. The core of the issue is that this proposal aims to change the landscape of lending for a specific demographic, people who are often on the edge of financial exclusion. If you change where they borrow money from, you inevitably change how they prioritize paying it back. So while the letter itself is political, the outcomes are entirely practical for the industry.
So let's unpack the specifics of what's actually being proposed before we look at the consequences. The goal stated in this letter is fairly ambitious. They aren't just asking for a slight tweak. They want to double the size of the credit union sector.
Which is a bold target. To understand the scale of that, we need to look at where the sector is right now. We have seen growth. Between 2020 and 2025, credit union membership in the UK grew by about 9%. That brings the total membership to over 1.5 million people.
That sounds like a healthy number. 1.5 million members is a solid foundation.
It is a solid base, certainly, and they hold close to £5 billion in outstanding loans. However, context is vital here. If you look at the wider market, the total outstanding non-mortgage household debt sits at roughly £120 billion. So credit unions currently represent a small slice of the overall pie, around $5 billion out of that $120 billion.
Right. So even with that growth, there's still a niche player compared to the major banks and credit card issuers.
Yes.
But the argument from these MPs is that for the specific group of people they serve, lower income households, that niche is vital.
Precisely. And the push to double that size is not just about marketing, it's about structural changes. The letter to Rachel Reeves outlines specific amendments to the financial inclusion bill. They're looking for legislative levers to force growth. The objective is to create a robust alternative to high-cost credit.
So how do they plan to do this? You mentioned legislative levers. What are the actual mechanisms they're proposing to use?
There are a few key components. One of the biggest is involving housing associations. The proposal suggests placing a duty on housing associations to actively promote credit union membership to their tenants.
That seems like a strategic choice. Housing associations already have a direct line to millions of tenants, many of whom fall into that target demographic for affordable credit.
It's a very direct channel. Instead of a credit union trying to advertise on a billboard, you have a trusted housing provider essentially endorsing the credit union as a safe place to save and borrow. It changes the nature of the acquisition funnel entirely.
And there's also a component regarding saving schemes. Correct. It isn't just about lending.
That's the other half of the equation. The MPs are calling for credit unions to be given access to the government's Help to Save scheme. Currently, this is a government-backed initiative designed to encourage savings for people on benefits, offering a bonus on what they save. The proposal is to integrate credit unions into that ecosystem more fully.
And there was a mention of payroll as well.
Yes, a right-to-save mechanism. The idea is to create something akin to auto-enrollment for pensions, but for savings, deducted directly from payroll. This would normalize the idea of building a savings buffer alongside debt repayment.
Okay, so we have the landscape, a sector that's growing but still small relative to the total market, and a political push to accelerate that growth through housing associations and government schemes. Now, let's pivot to why this matters for the people listening to this show, the creditors and the collectors. You mentioned earlier that this changes the repayment dynamic. Let's look at that.
This is the psychological aspect of collections. When a consumer has limited funds and multiple debts, they make choices about who to pay first. We call this the payment hierarchy. Traditionally, this hierarchy is driven by consequences. You pay your mortgage or rent because you don't want to lose your home. You pay your car or finance because you need to get to work.
And unsecured debt, credit cards, personal loans usually falls to the bottom of that list because the immediate consequences of non-payment are less tangible than, losing your house.
Generally, yes. But credit unions introduce a different variable, the relationship factor. Credit unions are often community-based. They feel local. They feel ethical.
It's the difference between owing money to a faceless institution headquartered in a skyscraper in London versus owing money to a cooperative that supports your local community or your profession.
Exactly. This creates a priority shift. If a borrower owes money to a distant, unsecured creditor and also owes money to a local credit union, the data suggests, and the logic dictates, that the local option often wins out. The borrower feels a moral obligation to the credit union that they might not feel toward a large commercial lender.
Because it feels like they're letting down their neighbors or their peers rather than just missing a payment to a corporation.
That's the dynamic.
Yeah.
So if the sector doubles in size as proposed, we could see a tangible shift in settlement dynamics. For commercial creditors, it means you might find yourself further down the list of priorities, not because of legal enforcement, but because of emotional and ethical prioritization by the debtor.
That is a crucial point. It's not just about who shouts the loudest. It's about who has the strongest connection to the customer. But there's another side to this, isn't there? If people have access to better credit, surely that prevents some of the messy situations collectors have to deal with.
That is the potential upside. We talk a lot about debt spirals, where a consumer takes out high-cost credit to pay off other debts, leading to an unmanageable situation. If this proposal succeeds and more people have access to affordable, lower-interest loans from credit unions, we should theoretically see fewer of those severe escalations.
So fewer cases where the debt has ballooned to 3 or 4 times the original principal because of interest and fees.
Correct. For a collections team, this changes the portfolio mix. You might see a higher share of cases that are actually workable. If the customer hasn't been crushed by payday-style interest rates, they're more likely to have the capacity to agree to a repayment plan.
That sounds positive for everyone. A workable customer is a paying customer.
It is positive, but it comes with a trade-off. The collections industry, particularly in the debt purchase sector, has traditionally relied on a certain volume of recoveries from people who are in that repeat borrowing cycle. If that cycle is broken, which is undoubtedly a good thing for society, it does mean that the operational models relying on that specific type of churn might need to adjust.
It essentially cleans up the market, but it also means the easy wins, if you can call them that, from high-interest churning might disappear. The remaining debt is cleaner, but perhaps harder to collect if you aren't the priority creditor.
Precisely. It moves the goalposts.
I want to go back to the housing association proposal. Placing a duty on housing associations to promote credit unions seems like a very specific targeting strategy. What does that tell us about where the focus is?
It tells us that the proponents of this plan are looking at the data. Tenants in social housing often overlap with cohorts that have higher arrears and lower financial resilience. By using housing associations as the gatekeepers, they are moving the intervention point.
What do you mean by moving the intervention point?
Currently, many people only find out about debt advice or affordable credit alternatives when they are already in crisis, when the default notice has landed. By integrating credit unions into the housing association relationship, the goal is to offer these options earlier.
So, when a tenant signs a lease or during a routine check-in, they might be told, if you need to buy a washing machine, don't go to a high-cost lender, talk to this credit union.
Exactly. It facilitates earlier budgeting support. It moves the conversation from how do we fix this disaster to how do we prevent this disaster. If a tenant can access a small, affordable loan for that washing machine, they don't miss their rent and they don't max out a credit card.
Which, again, creates an outcome that flows through the system. If they aren't maxing out the credit card, they aren't falling into the collections bucket for that card issuer. It suppresses the volume of bad debt entering the system from that specific demographic.
And it also links back to the help to save aspect. The proposal isn't just about borrowing, it's about building a buffer. One of the main reasons payment plans fail is a sudden financial shock, a broken boiler, a car repair.
The emergency that wipes out the disposable income for the month.
Yes. If credit unions can effectively use the help to save scheme to get these households to build up even a modest emergency fund, the stability of repayment plans across the board improves. A customer with a 500-pound buffer is far less likely to default on a structured repayment plan than one with zero savings.
So practically speaking, if this works, we get a more resilient customer base, but we also get a customer base that is more closely tied to the credit union ecosystem.
That's the synthesis. Better resilience, but a shift in loyalty.
There was also a point about sector resilience easing rules for credit unions lending to each other. Why is that in there?
That is about liquidity and product range. Individual credit unions can be quite small. If they're allowed to lend to each other more easily, they can pool resources. It means a smaller credit union might be able to offer a product that it couldn't support on its own balance sheet. It strengthens the network, making it a more viable competitor to commercial lenders.
It makes them less fragile. If one local area has a downturn, the credit union isn't necessarily wiped out if it has backing from the wider network.
Exactly. It creates a more robust system.
Okay, so we've established the what and the why. Now I want to focus on the what now. If I'm running a collections floor or managing a creditor strategy, what do I actually do with this information? We can't just wait for the legislation to pass.
No, waiting is rarely the right strategy. There are immediate steps that can be taken to align with this potential shift. The first is updating what we might call the vulnerability and affordability playbook.
What does that look like in practice?
When an agent is speaking to a customer who is struggling and affordability is tight, the standard options are usually a payment plan or breathing space. But if we acknowledge this shift, there's an opportunity to add a credit union pathway.
Meaning the agent actually suggests the credit union.
It's a delicate balance, but yes. If a customer has good engagement but simply cannot make the math work because of other high-cost debts, suggesting they speak to a local credit union about consolidation, well, it can be beneficial.
It sounds counterintuitive for a collector to say, go borrow money elsewhere.
It does, but think about the outcome. If they borrow from a credit union at a fair rate to clear a high-interest burden, they free up disposable income. That disposable income can then be used to service your debt. It's about enabling the customer to pay you.
So it's treating the credit union as a tool for rehabilitation rather than just a competitor.
Correct. It transforms the conversation from "you must pay me" to "here is a way you might be able to restructure your finances so you can pay me."
That requires a fair bit of training for the agents, though. They need to know what a credit union actually is and how to frame that suggestion without giving financial advice they aren't qualified to give.
Absolutely. It requires scripted signposting, not advisory language. Have you considered looking into local credit unions which may offer lower rates? Is very different from "you should take out a loan with the credit union."
The second practical action you noted was about segmentation strategy. This links back to the housing association point.
It does. Data is your friend here. Creditors should be looking at their portfolios and trying to identify accounts that are likely linked to social housing or have irregular income patterns.
Why flag them specifically?
Because if the housing associations start actively promoting credit unions as proposed, these are the customers whose behavior will change the fastest. They are the ones who will be presented with these new options first.
So if you know a segment of your book is in social housing, you should anticipate that they might soon have access to refinancing options.
And that might change how you prioritize them for contact. If you know they might be getting access to a resolution route like a credit union loan, you want to be the creditor they're talking to when that happens.
Which brings us to the speed of engagement. You called it tightening the early stage cadence.
Yes. In a world where there are more options for the debtor, more off-ramps from debt stress speed matters. If the market shifts toward cheaper credit and structured saving, the creditor who engages first is the one most likely to cure the debt.
Because if they wait, the customer might have already consolidated their debts with the credit union and prioritized the other creditors who got in touch earlier.
Or they might have simply chosen a different creditor to keep current because that creditor established a relationship. If the customer has limited capacity, they can't pay everyone. They pay the people they speak to and the people they feel committed to.
It effectively becomes a race to establish the relationship. If the credit union is the local, ethical, relationship-based option, the commercial creditor needs to work harder to be seen as human and approachable.
That is the key. You have to compete on the human front.
There's also a point about regulatory and complaint risk. Even though credit unions are often seen as the good guys, how does their rise affect the compliance landscape for everyone else?
It raises the bar. If financial inclusion measures gain traction, and we have a government actively pushing for fairer credit, the definition of what is considered fair treatment tightens.
Even if the regulations themselves don't change immediately.
The expectations change. Regulators like the FCA look at the market context. If there is a viable, ethical alternative available, and a commercial lender is seen to be acting aggressively or without forbearance, the contrast is starker.
So it's about the optics and the benchmarking.
Exactly. Expect higher scrutiny around forbearance. Creditors should be reviewing their letters, their scripts, and their escalation triggers. You need to ensure you are aligned with FCA-style expectations of fairness, regardless of your actual regulatory status.
Because if a complaint goes to the ombudsman and the defense is, technically we follow the rules, but the behavior looks predatory compared to the ethical credit union alternative, that's a losing battle.
It is a reputation risk and a redress risk. The wind is blowing toward greater protection and inclusivity. You don't want to be the creditor leaning into the wind.
So practically, that means looking at your hardship processes. Are you offering enough breathing space? Are you listening when a customer says they are exploring a credit union option?
And documenting it. If a customer says, I'm talking to my housing officer about a credit union loan, the system needs to record that and perhaps pause activity to allow that solution to materialize.
That seems like a very tactical tweak that could save a lot of wasted effort. If a solution is in the pipeline, don't harass the customer out of it.
Precisely. Let the solution work.
I want to touch on the right to save via payroll ID again. We glossed over it, but the psychological impact of that is substantial. Normalizing saving alongside debt repayment.
It is a fundamental shift in mindset. For a long time, the industry view was binary. You're either a saver or a borrower. If you have debt, you should use every penny to pay it off before you save.
Which makes mathematical sense. Why earn 2% on savings when you're paying 20% on debt?
Mathematically, yes. But psychologically and behaviorally, it's flawed. If you have zero savings, the slightest bump in the road forces you back into borrowing. The right to save proposal acknowledges that sustainability requires a buffer.
So for creditors, seeing a customer putting money into savings shouldn't be viewed as them hiding money that should go to the debt.
It should be viewed as them building the resilience to ensure they can maintain payments to the debt. A creditor should actually encourage that small savings habit because it protects the payment plan.
That is a big cultural shift for some collections departments, I imagine. Seeing a 50-pound deduction for savings and not asking for it to be diverted to the arrears.
It requires looking at the long-term value of the account, not just the cash collected this month.
So putting this all together, we have a proposal that is gaining political momentum. It uses trusted intermediaries, housing associations, to scale up a sector that is seen as more ethical. It introduces mechanisms to make saving and borrowing easier for the low-income demographic.
And for the collections industry, it presents both a challenge and an opportunity. The challenge is the priority shift, competing with a local hero creditor. The opportunity is a more stable customer base and new pathways to resolution if we're smart enough to use them.
It feels like the days of the one-size-fits-all collections strategy are getting further behind us. This demands nuance.
It demands agility. You need to be able to spot these segments and treat them differently.
Before we wrap up, let's talk about what we need to keep an eye on. This is a proposal, not a law yet. What are the indicators that this is actually happening?
The first thing to watch is the financial inclusion bill itself. Will these amendments be accepted, and how quickly? Legislative time is a scarce resource.
And the help to save access.
That's a key technical hurdle. If the Treasury approves credit union access to that scheme, it's a green light. It signals that the government is putting money behind the policy.
And beyond the politics, we should be watching the data.
Yes, watch the membership numbers. If that 1.5 million figure starts climbing towards 2 or 3 million, we know the strategy is working. And specifically, look at arrears trends in social housing. If this works, we should see those arrears stabilize or drop.
That would be the proof of concept.
Ultimately, political momentum is one thing. But as we always say, timelines and funding are the real indicators of change. Proposals are free. Implementation costs money. We need to see if the funding follows the rhetoric.
That is the reality check. It's easy to write a letter. It's harder to build the infrastructure to double a financial sector.
But the direction of travel is clear. Whether this specific plan happens exactly as written or not, the push for community-based affordable credit is not going away.
And that's the takeaway. Whether it's this bill or the next one, the landscape is shifting toward this model. Creditors who adapt now by updating their playbooks, refining their segmentation, and focusing on early human engagement will be ready for it.
And those who ignore it might find themselves at the bottom of the payment hierarchy, wondering why their calls aren't being answered.
A sobering thought to end on. It's about staying relevant in the customer's financial life. Thank you for walking us through that. It's a complex topic, but one that definitely matters for our day-to-day work.
My pleasure. It's always about seeing the full picture.
And for those listening, take a look at your own vulnerability strategies this week. Ask yourself, if my customer had a cheaper option, would I know to tell them? That's all for this episode of Debt Matters. We will catch you next time.